We will call this special session, Marion County Board of Supervisors, to order. Roll call. Mr. Grandia.
Keisha Johnner.
Here.
Mark Ramey.
Here.
Steve McCombs.
Here. Would entertain a motion on this afternoon's agenda.
Make a motion to approve this afternoon's agenda.
Second. McCombs. Aye. Ramey.
Aye.
Johnner.
Aye.
All right, on to business. We are here at budget kickoff. As I was telling, or Jake and I were reminiscing this morning, this is our 12th budget together. Time flies when you're having fun. It goes by fast, doesn't it, Jake?
It goes by fast.
So we have a couple of things we want to get done this afternoon during this session. We'll do, of course, our kickoff, which Jake always takes us through the high level numbers, where we're standing in our funds. We'll go through the charts and graphs that he has. Board, feel free to ask questions. Of course, during this time, it's always a good refresher on the structure of the budget and where various funding sources stand, the impact of property tax reform. Those items will be discussed. Then Tyler will be up for the road department. We'll talk impact and then some miscellaneous, and that'll be this afternoon. And then tomorrow we kick off at 9 o'clock. When do we kick off? 9 o'clock tomorrow?
9 o'clock. And I will, Missy, I just talked to Missy just a little bit ago. She's 9 o'clock tomorrow morning. And she is, more than aware that she has 9 o'clock and fully intends on being here unless, roads don't allow. But I spoke for you just a little bit and said that you would work with her if she couldn't get here at 9 o'clock.
Okay, absolutely. If any adjustments
She
for
was-
weather,
just wanted you to know
roads, or
she
anything
was-
like that.
Very well aware. And
No, I appreciate that,
Concern.
Jake. Thank you. All right.
And we have a break. Just as a reminder, we're doing planning and zoning and then public
Yes.
health and then we have a little bit of a break. Come back at 1.
We'll have a lunch break, and it does give us some flexibility if we need to move things around.
Right.
But we also have a break, kind of hardwired into the session. So yeah, thank you, Keisha, for that. With that, Mr. Grandia, kick us off.
Okay, so, here we go. Some, common stuff that we've seen throughout the years. I'm gonna just kind of ramble here a little bit, just to kind of kick this off from a higher approach, and a couple of the old fund balance worksheets that we've seen in the past. We've been using, year one with, I don't know what to call them. Sometimes I call them the budget BOS worksheets. I refer to Lindsay's worksheets. I don't know if that's what we want, but when we talk about the worksheets that all the departments have entered into and kind of flowing through, that's what we've been calling that. So departments have been entering into Lindsay's worksheets. I use those, our office used those to enter into the solutions budget programming, created state reports, and we'll kind of talk through the steps here a little bit. But just want everybody to be aware that what they have entered at the individual chart of account level for all revenues and expenses is critical. And thank you for doing that. I think everybody entered, as far as I tell, or I took what got entered in for all the departments. And that is what flows through at that individual chart of account level that we pay bills and treasurer's office, Michaela and Kristen do miscellaneous receipts. That's what flows through to all this information that you guys are going to see at the state report level or the macro level, for a better term. But it is just appreciated that everybody got their information in. Everything is labeled version 1. I think we all understand there may be changes, will be changes, whatever words you want to use, but you have to have a starting point. And this is version 1. If changes are ordered or changes requested, they can easily be done. We'll have multiple versions, but you have to have a starting point, and this is it. So thank you to the departments, everybody, for turning stuff in, and we'll go from there. So I thought this year, this is a little bit different than what we've done in the past, and it may not be easiest to see on the top, but this comes from instructions that is publicly available on Department of Management website. It's what we use in the auditor's office this is from Carrie Johnson, Department of Management, who handles the county budgets on the software program. We do the budgeting program from the information provided by the Board of Supervisors and departments onto solutions in our in-house. And then once the product is done, we enter it onto the state Department of Management website to create public notices and to make public, and that's where we file and that's where they get their information. So what we have before us on the screen at least is from that manual, the county budget instructions. Cities get similar instructions. They go through a very similar process. But I thought I might just, because this is year one, departments like the assessor's office and different departments have been dealing with House File 718. This is the first year that you guys are going to see it, results from that with your levy. I thought I just might show a couple of highlights from these instructions of what House File 718 has implemented. Just to kind of highlight here, changes to the county general basic and rural basic. House File 718 puts a goal of maintaining the caps at the code allowed 350 and 3 for the general fund and 395 for rural funds. They've given counties 4 years for that to become a hard cap. I think there are 30 counties. They've been deemed 30 counties that were over the $3.50 general levy limit. And effectively, the legislature wants all counties to get down to the statutory maximums, and cities as well. Cities at their $8.10. They want them that to be a hard cap as well, with some growth limitations. And they've given 4 years to get there. And the $3.50, you need to think about that moving forward as a maximum allowed. The dollar amount might change, but it's a maximum that the state is allowing at this point. The House File 718 is limiting growth for the main 2 funds that counties use, the general fund and the rural fund, at 3% growth. So taxable values are done in December. We had to have those done and completed and out to everybody by December 31. That's part of the process that we'll see on a timeline. We got that goal met and accomplished, got our taxable valuation project done, which moves into budget. So from that, the next thing what 718 did, it eliminates the max levy hearing. So eliminates the max levy hearing, and it adds an additional proposed tax hearing and a notice and mailing. So we don't have what's called the max levy notice anymore. We do have, are going to go through 2 public hearings in your budget, and we have to set those dates, separate meetings before, so there's quite a timeline. The deadline to actually have it to the state is April 30th. The county will have to have stuff finalized before that to meet all these deadlines. The other thing that's really big, first time, I don't know how it's going to work exactly because we've never done it, but the proposed tax hearing with notice and mailing. So my office is now responsible to send, we're going to call it a pre-estimated tax notice out to all taxpayers. They're still actually working on trying to determine how those are sent and to what all taxpayers mean. Effectively, the goal here is to notify taxpayers of what counties, cities, and schools are going to be a maximum amount they'll tax in their main funds. For the county, it's general fund and rural fund. It is not debt service fund. It is not any other things. And also indicating when the public hearings are going to be. So my office is now, this is a first time, I'm gonna use an outsource company. So it's effectively like a tax statement. And we have to print for every tax parcel with the estimated FY25 taxes and when the public hearings for those 3 jurisdictions will be. Cities and counties and schools have to have that information onto the Department of Management website by March 15. So that's a key date for us here as well. And then I have to have those in the mail by March 20. So they gave us 5 days. So,
Jake,
yep.
will they then, each entity, so the county, city, and school will send out these?
No,
Okay, you guys are gonna
all
consolidate.
3 will be
Consolidated.
consolidated onto a single unit generated from our office now. My office, the auditor's offices around the state have been given this responsibility. Department of Management is working with our vendors. I'm not hand typing these or anything like that. We're definitely using software. I mean, I'm not trying to make, it's just a first. We'll see how it goes. It's going to be key that we have 9 cities, you know, the 5 schools that were control counties, 4 of the 9 cities. And the county have to have that information in for us to be able to send this. All that information needs to be Department of Management by the 15th. We in turn then, that has to be organized by Department of Management, downloaded into our software, and then we're gonna use an outsourced company. We're not. And if it goes like I think it is at this point, we can put multiple parcels into a single mailing, you might say. So we don't have to send, we have about 26,000 parcels in Marion County. Tax statements go out by parcel. I think this is gonna be able to go out in just over 15,000 packages, I think, because they can put multiple parcels together. If a farmer has six pieces of parcels, I think all six can go in an envelope. So our outsourced company is gonna be able to do that. But this is new. When we pay for it, we pay for the postage and printing. So that is part of the new part of the proposed tax hearing and notice and mailing. So I don't want to go any further down the weeds on that, but we are all just going to have to be aware that assessors send their assessment notices in the spring, March range, I believe. This is going out March, April range. This is going out. So that's for assessors will send notices for 1/1/24. This pre-estimated notice that it's not a bill, it's just a notice, is going to be for the FY25 year, but no taxes are due to the treasurer, and I'm sure it'll generate phone calls to the treasurer. And then so that'll be for 25, and then we'll send the actual tax statements out in July of 25.
So
25.
will there be an explanation on these notices that the county portion does not contemplate your entire levy?
It breaks it out by levy, by the jurisdiction. So it should show each individual one.
Okay, so they'll understand, they'll be able to sync these two statements up.
So they will be able to compare this pre-notice to the eventual tax statement. On the bottom of the tax statement itself is a consolidated levy. This is individuals. The way to sync that will be on the bottom of the tax statement where it shows how much goes to each place.
Right.
And the other thing is, I don't know what the rules are for cities and schools. For the county, we're only to put the general fund and the general and the rural fund, Fund 1 and Fund 11. We also have our debt service fund and our general supplemental fund. So that's not included in the notice.
And that's what I mean, Jake. I mean,
Oh.
when they get their statement from the assessor,
I missed
the whole levy's in there.
yes, sir.
Who's gonna, I mean, they're gonna look at one value and look at another and go, wait a minute, this is more.
Yeah.
Why?
So being the first time, we're gonna have to figure out what the questions are.
And I realize that's not a question that you can add. That's a
Right.
question for legislators who I'm not, I promise I'm gonna
Yeah.
be good right now.
So we'll see. That's a really tight timeline. And that's why everything's ahead a little bit of schedule and it'll be new, but that's one of the changes. So and the meeting notices are one of the other things about the meeting is when you have one of these public hearings, it can't be part of another meeting. So it doesn't say we can't be on the same day.
Right.
So you can guys have your stuff ready for your public notice and it can be on a Tuesday or whatever, but it will have to be a separate meeting with a separate agenda. And we'll put public notices out just like always. So there will be 2 of those as well. And then there's the normal 10 and 20-day notices after each meeting and after each date is set. So those are kind of the highlights. That portion of House File 718. One of the other things about 718 is that limitation growth, like I said, and we're going to talk about that a little bit later, limiting growth to no more than 3% of taxable value. A couple other things, just as a reminder, as this year goes, not part of 718, but part of one of the earlier year before, commercial industrial is being phased out. So the county's in year 3 of commercial industrial money coming back from the state. So each year it decreases how much comes back to all the jurisdictions. Part of the new thing on also is the two-phase taxable values for commercial industrial. So all commercial industrial values now, the first 150,000 get residential rollback, and then after that, it's at the 90% commercial rollback. So these are all just things that come into play to get to our taxable value that we'll look at
Sure.
earlier. All right. And the state is replacing that somewhat. Business property tax credit went away and for people that signed up, and it was replaced by the 2-tier, and we'll see when that goes away. But one of the things new is the Homestead 65 is tax exemption will be on this statement. The assessor's office had to go through all the signups of that before last year, right before taxes went out, but this is be the first year that Homestead 65 will be on the tax statements, and I will show you on your values how much of that is in the county. So that's an exemption, and it is not replaced by the state. Regular homestead will continue to be replaced by the state, but Homestead 65 is not replaced by the state. Military exemption, new in House File 718. The military exemption exists, and they actually increased it from $1,852 of taxable value to $4,000 of taxable value. As taxpayer, it's great. As taxpayer, it's great. But they are not replacing any military credit or any military exemption anymore. So that credit is gone. The exemption stays for the taxpayer, but the state's not paying that back for cities, counties, or schools.
Okay.
So that's part of 718 as well. Those are the main highlights, and I'll show you what those kind of look like in an overview. If you want to go to the next page. This is just more of that and kind of probably giving better detail of what I just kind of described. But I just wanted to give you a high level of some of the changes for 718.
Very good.
Let's go to the next page. So hard to read on the screen. I have these available for you guys if you want, but this is Department of Management's kind of template for timeline, a calendar for the steps to go through, and it kind of lists out each one. I won't read each one of these to you, but this is kind of a good timeline on how to get things done. So there is actually code that says when departments are supposed to turn stuff into the auditor's office, which was by January 15. We actually did really good on that. And then I'm supposed to have that information compiled and given to you guys on the state forms by the 20th, which we're pretty close. And I have those forms available in there. I can show you later as well. Then it goes through your processes of getting to your next steps and the mailings and the hearings and things like that. So this is just kind of so everybody can see if they want a suggested at least minimum sequence of time to get to where you need to be. Tyler, this timeline does not take into account, I believe Tyler mentioned this in a last meeting, but his budget and timeline doesn't necessarily sync exactly with this, right? Your DOT budget. Your DOT budget is still the old timeline, right? Which we can work with. That's fine. Tyler will work with it.
Yeah, statutorily, the DOT deadline of April 15th did not change.
Yeah. And we're April 30th.
I think I forwarded you an email from our
Yep.
service bureau regarding that, or from local, DOT local systems, giving us some guidance to that effect.
So when he was talking, that's what he was referring to.
Okay.
All right, can you go to the next one? I'll just talk about taxable valuations. This is the project that was due by December 31. This is the annual report. All this is available on Department of Management website. You can access it for any county in the state, all historical years. So this is basically a summary page. It's the one I use the most, and it shows taxable values for Marion County. I have highlighted in red. This is what we use for our tax levies. You can see there's cities and schools. There's a page 2 that has townships, and but this is what we all use. The numbers in column A are what populates to our the budget software, and this is what gets used. So the top number there of taxable value, the assessor places value at 100% throughout the county, and then the state tells us what rollbacks or how much each jurisdiction can access. That's effectively what this is. This column A is what we use then to apply to the levies that you as a board will set. Some of it is pretty determined by the state, but this is what's used. So $925,707,755, if I can see that from here. That's the rural fund. That is the taxable valuation that's encompassed in the 12 townships. And that's what's used to drive our rural fund. Right now, that current levy is $3.95. The urban one underneath it is what the taxable valuation that's in all of our 9 cities in the county. And they obviously all use smaller numbers, but pieces of this, the county just accesses countywide for the grand total. That grand total is our new number. And this is based off 1/1/23 taxable values to be used in the FY25 budget year. So this is the numbers that we will use moving forward when you set levies. If you change a levy or adjust a levy, it's multiplied by this amount divided by 1,000 to see how much tax dollars you would get.
Right.
Always realize that, this is just what counties are using. So this is our total taxable value. All right. How much did that change as a county overall? Go to the next one. So this is just the old data information of changes over the years. Again, this is taxable value, not 100% value. So this year we had a 5% growth in our taxable value overall.
Right.
Overall. Residential, I think we all got assessment notices that had pretty high values, or some increases, but the rollback, like residential rollback went down 6% or 8%. The ag rollback went down 20%. That's what it sounds like at the courthouse.
Thank you. I want to make sure nobody fell.
Yeah.
Yeah, I don't know what that was. So our overall county growth,
Or that side of the building fell in.
maybe, they're bored already. Our overall growth went up 5%. Okay. All right, so,
Can I highlight two
Yep.
things on here, Jake? You
Yep.
know what I'm gonna do.
yeah,
Just so we can.
I-
When we think about these values, states and. Look at that number, that number.
yeah. So most of those big numbers are revalue years.
And
Oh,
Housing.
billions of dollars into the economy. This was COVID. That was the great financial crisis.
oh,
So sometimes we deal with the anomalies of a bigger macro picture than just normal revaluation. There are things going on in the larger world that impact all that. And those two numbers elevate those valuations considerably. Oh, sorry. We need a roving mic when I do that. But the 2 years on the chart, when we got FY 2021, and then you go back to 08, 09. So that you got the great financial crisis, and then you had the beginnings of COVID with all the stimulus dollars that were pumped into the economy. And they corresponded to massive increases in valuation. So just keep that in mind when the government starts printing checks and printing money. There's my
Okay.
there's my political
I
statement
don't.
for the first 15 minutes.
All right.
If you
so-
haven't been to one of these meetings, this is going to happen a lot. So just be prepared. Joe paid for this. So
All right, overall 5% growth. Let's go to the next one. We're still kind of leaning into that new house file that we're just at 17 for the first time. So when we were talking about the changes from those instructions, we talked about the military tax exemption and the homestead. It's actually Homestead 65. This is another report from our valuation project that has to be done by December 31 for everybody to use. This is the summary page from Marion County. I just wanted to highlight just so you guys can see. So this is the taxable valuation that is, you have your gross valuation and then you reduce the military and the Homestead 65 to get to your net valuation, what we use. So this is kind of the effect of how much taxable valuation was being included in these two exemptions. Okay, just for picture wise. What's next? Yeah, go ahead. This is the amount that's in the areas that's in tax increment finance districts. So again, same concept. These are just in TIF districts. All right, so this page right here. This, now we get into the gritty of what you guys have to deal with from a levy standpoint. All right, so this is a supplied, I did not create this worksheet. This worksheet is supplied by the Department of Management. All I did was fill in the yellow sections. But what effectively this is per House File 718, you put in how much tax dollars you collected for the general fund and the rural fund last year, valuations from last year, new valuations this year. It calculates the taxable growth, which as you can see was 5.05 for countywide and 2.13 for rural. And then it tells you what you're allowed, the maximum levy you're allowed as a Board of Supervisors to implement in this year's budget. So the top one is the general fund. 5% growth is more than 3, so it reduces it down to the 3%. So the maximum levy rate you can do for general fund this year is $3.43137. That is effectively your 350. That is your max. As long as the county stays at that level, the board, as a board, you're allowed to maintain and use the general supplemental levy.
Right.
If you go below that, then the general supplemental levy needs to go away. Okay? The general supplemental levy does not have a limitation or growth on it, and it uses the total valuation. Actually, all these use the total valuation. They got the limitation by changing the levy. So you have flexibility for the general supplemental.
So Jake, just so myself and the public understands, the 343 will be the new general, which would be, we'd say 350.
Correct.
Okay. Is it any time, can that change again, or does it
It
always?
will
have-
change next year probably. It's
Right,
the
but
new
I,
base.
it's the new base, but you can never, I'm just trying to make sure that I remember on
So-
House File. I couldn't remember if there was a year that was capped, because you said you had to be within by like 26. You had to, is it 2026 that you had to be down to the 350?
It's 4
for those-
years. It's 4 years from now.
Oh, it's 4 years. Okay,
Yeah.
so 2020, okay.
So next year, if valuations, it's not a revalue year next year. So let's say valuations, but they go up anyway, growth. The levy will go lower. If
It could go
valuations
over the
decrease,
3%, yeah.
if they decrease
Yeah.
next year, it could go back up to
Yeah, It's
350, but no.
it's an inverse calculation. So if our values continue to increase at 5% or more, we'll watch that general fund levy go down because they're capping it at 3. But if they decrease, if we have somehow property values decline, it could go back up to 350.
It could.
But it cannot exceed 350.
That's correct. It will not exceed 350 unless there's another change.
Correct.
Yep. So, yeah, and then after, I think after, I don't know what they're gonna do in 4 years, so.
Yeah.
The rural fund, the next one down, the main driver is, the growth was only 2.13%, so the maximum allowed is 395 and it stays.
Right.
And this is the main driver that the secondary road transfer comes from. And when Tyler referred earlier today, that there are a few counties possibly that aren't gonna be able to meet their statutory requirement for that transfer. I'm assuming that their valuation decreased. It was probably a rural county. And when you put in a 20%, when rollbacks for ag went down 20%, maybe they didn't have growth and they don't have enough. Maybe they just don't have enough to meet their statutory requirement. So from a board standpoint, you guys you will set 4 levies. General fund, general supplemental, rural fund, and debt service. This effectively is telling you that your rural fund can be no more than 343, and if it goes less, you lose the supplemental, and your,
No, your
that was the
your
fund, I'm
general
sorry.
fund,
I said, that, yeah,
Yeah.
general fund, and the rural fund is 395.
right.
We don't have a supplemental, so if you go lower than that, you go lower than that, but it still needs to meet the statutory requirement for the transfer.
Got it.
Okay. So that's the math on that. So moving forward, I always start version 1 using last year's levies. So moving forward, and you'll see what the fund balances are and the projected fund balances and things. It's using a $3.43 levy for FY25. Okay, and 395. Just
Mhm.
want you guys to know where that's coming from.
Yep.
All right, what's the next page? Am I doing?
So did you say the $200,000 new growth? Is that, did you just say
Yeah.
that? I missed that. Okay.
So effective, I did not, but I think what you said is the new growth. So for general fund, effectively, which is basically like last year, and is any new tax growth. This isn't receipts, revenues, anything else. The general fund, due to this limitation, has available, if you levy at the max $3.43, which is recommended, there's just short of $200,000 new tax revenue. If there's additional fees, grants, all
That's
those
different.
things. they're
Yeah,
different.
that's additive.
Okay, so that's the new money we talk about. It's about 200,000, and that's general fund or fund one.
Can I ask a question about something Jake said?
Yeah.
What?
And I'm
Uh,
nervous.
You said if it drops below 350, the supplemental goes away?
So-
We're
If
in
it
that
drops below
situation?
the max.
So whatever-
343 is our new max.
And we're, because of the new legislation, they're still considering 343
Yeah.
the max.
Correct.
Gotcha.
Correct.
Okay.
Because if, I mean, what everybody, we go through this every year, but if you now, if that's the statutory max, if you drop below, all the liabilities from Fund Two go to Fund One.
Correct. Okay. We good? So if you go to the next page, this is what's used in this version one. This is it says adopted at the top. It's not. This is just a report that's printed. So this is the levies in version one. It's the new max at 343. It's last year's general supplemental at $2, 2.00107. Last year you guys decreased it 20 cents. So that's, I always start with that level.
Mhm.
The debt service, and I'm going to show you how I get to this, is down to 17 cents, and I'll show you why. So the debt service levy is 17 cents, and that does capture all the taxable value in the county, including TIF. And then 395 on the rural. So that's the tax, that would be, if somebody asks what the total tax is for the tax ask for the county, that's this number at this point.
Mhm.
It gives you very little flexibility as a board to maneuver because you have to pay your debt too.
So Jake, just for clarity's sake, sometimes when people see our numbers, they see a county that has a 29 to 31 million dollar budget. But we collect 14.5
Mhm.
in tax. Where does the rest of it come?
Well, Michaela, the treasurer's office, the tax bills go out and I think we hit like 60 million this year. It's the first year we were over. So Michaela collects like $60 million in property taxes. The rest goes to cities and schools and townships.
Right. So this is for everybody to understand. We're about 14.5 million, not 30.
That's correct.
And then we have other grants and things like that that are not included in that number.
This isn't
that
our total
elevate that
budget.
number.
This is our tax
Our
ask, but it's
tax, yeah,
definitely not the total amount of property taxes collected.
right.
Okay. On the next screen, this is how I came up. This is effectively the long-term debt schedule that's in the department management software.
Renee, can you move that box?
So the county has 3 issuances. To get to the 17 cents, the county has 3 issuances. It shows the principal due, the interest due, a small administration fee that we have to pay. We don't pay quite that much, but you need to budget. And the total obligation due. And then how much is paid from other outside funds. And then whatever's left has to come from the taxpayers. So that gets us to the 17 cents. In this Prairie Ridge, the amount coming from an outside party is from the TIF increment from the Prairie Ridge project that these are estimations for how much will be diverted back to us next year, 71,909. The VA one, that the county got the demolition grant. So I applied part of the demolition grant to the principal and interest
Yep.
payment.
Yep.
Because I felt it needed to be used. And then the new Adkins project in Pleasantville, I have 50,145 because that's how much the county has to come up with from this cycle of tax collections. There's actually another 50,145 in interest that needs to be paid, but we have that for capitalized interest. So I see that I need to change this chart. I need to put interest due of double that and then put amount paid by other sources of 50,145, but the net
50,145.
is the same.
Yes. Yeah. Very good.
So last year's debt levy was like 32 cents, I think, or something close to that. And this is a decrease, but it's in this case, because the demolition grant that was acquired here take care of a couple years payments.
Yep. Yep. Excellent. Excellent.
Sorry? 17 cents. If you go back, are you good, Keisha? 0.17744, the column R.
Mhm.
And then the debt service also gets to capture all taxable value. So that means if it's in tax increment or not. So it accesses the 2 million or billion. That's a big number. Column Q is what that accesses.
Mhm. Yep.
Okay. So that's where how we get to version 1.
And no more law enforcement.
No, this is the final year of the payment for the local option, for
Yep.
the law enforcement service. Paid off,
Free and clear now,
free and
Jason.
clear.
Sort of.
And I'll show you, we'll show you in that local option sales tax. I just have one slide in there for local option sales tax. You know, we always budgeted that $300,000 transfer because you always used that as a tax relief, and that's no longer there.
Right.
So then I go to the next page, and this is just a history of one more. This is just this one. Thank you. You guys always like to see history of levies. So this is just version 1 for now with general supplemental as it is, and the new general fund, the new debt service, and
It's an exciting number.
well, it is. You have to realize it really helped having that demolition grant take care of
Yes.
that first thing for the VA, because it would be
Yes.
right up there where it was.
Oh, sure, sure. But considering what we've done with Fund 2,
Yeah, you're
I mean,
gonna,
the 7 cents that the state did is from a levy standpoint, we did more
yeah, and
getting that grant and lowering Fund 2 than the
yeah,
state calculation.
And you
did.
guys will see what you'll have to decide what you want to do with that. I'll just show you at the high level coming up here.
Yep, yep.
It definitely had an effect, and it's affecting the fund balance too.
I mean,
So you'll
do
see.
we know, Jake, I mean, when you look at where we started in 10 at 10.92 for our entire levy, now we're at 9.55. I mean, the argument that the state makes is that we don't lower taxes. Yes, we do. That's clear we do.
We lower the levy.
Well, which lowers taxes.
Yeah, I think
I
I
mean, I
have the-
can't control valuation because that's the Fed and that's the assessor. So how many counties are in a situation, do we have any idea
What situation?
of that kind of levy reduction?
I don't know. All the levy rates are available on
Okay.
farm management, but I don't know, Mark. I'm sorry.
Okay.
I was thinking I had the valuations on here too. Oh, that was up earlier. You could see what. the
Yeah.
valuation was.
Yeah, all right.
So that's where you are right now, and that's just a historical snapshot. So this is, I'm not gonna read all these. This is when we were talking earlier about the schedule, this is the summarized report that is to be given to you guys at this point. So this single page right here, this proposed budget summary is version 1, everything down to the departmental level entry by chart of account number summarized onto one page for your budget. I have these available if you want. And you can see, sometimes it's kind of scary looking at these because you can see negatives, you can see really decreases in fund balances, and it is. So if you look at column A, it looks like fund balance change is down 10 million. And it is from a budgeting standpoint. And we're going to look earlier. I mean, the general fund has a big decrease in it, but a lot of it is planned. It's got 1.5 million in it to this Junction 92
Yeah.
project.
Yep.
In that $10 million there, you have to budget to use. So all remaining ARPA money that you guys have,
Right.
like $3 million, $3 million plus dollars, is budgeted in that. There's no revenue coming in for that. It's just expense.
Right.
ARPA, there's another big one. Local option sales tax has quite a bit in it that is budgeted to be spent. And more than I'm drawing a blank. So it's always kind of scary. But once you start peeling off the pieces of what it is, then it helps a little bit. But the tobacco settlement is in that, Jason, I would
You
assume.
mean opioid? You mean the opioid settlement?
Yeah, I believe that would probably be in column B. Actually, I can tell you. Yep. That, and like, in that instance, you know, you budget for however much is here. So in Lindsay's worksheets or in the solutions, you budget for how much has been collected to date.
Sure. I mean, some of our big items from a revenue other than property tax would be the sale of our annex, opioid,
Yeah, and I didn't put anything in the revenue for sale of the.
right? But we've got that going on. So that's not insignificant. Plus we have interest income that we've never had.
Yeah, and we generally budget that very conservatively because it's just subject to change.
Sure,
So-
but in the reality of it is, I mean, if we're budgeting that at $120,000.
Right.
But we're generating on an annualized basis, $600,000 of interest, that.
Yeah.
We have to account for that somewhere.
Yeah, it does definitely come in actuals.
Okay.
Absolutely. It definitely comes in the actuals. Definitely.
Okay.
Yep.
So when I'm looking. 40 million.
Yep.
So in here, we've got, you said the ARPA funds.
Hmm.
Do we have any, we've issued all bonding debt, correct? So that's.
Yep.
And then, so what else is coming out of that? How much from million you projecting for Junction 92? I'm trying to
Oh.
understand why this is.
It's a big number.
Yeah.
So like one of the things you can look at, let's see. We just have to look across and see. Yeah.
So look right on this.
And we've kinda got that one broken up.
This total.
Yeah.
Here, so your subtotal, if I'm.
This,
wanna
you
read
do
it?
this one to this, yeah.
Yeah, so you're going from 34 to 39, Keisha,
Yeah.
so then you go from 37 to 42, so all of these subtotals are higher.
If you look at the capital projects line, I think it's 27.
Okay, that's.
Yeah.
So, because Tyler, we've been working to try and get that budgeted out per the board's resolutions. It's 3 different funds, but we're trying to put that into function 10, which is a capital assets function. So it's the function, it's the second series, when departments turn in their numbers, it's the second series of sequence numbers when they put in their chart of account, that tells it what line to go to there. So it's that capital projects is function 10, so there's a big jump right there. And we can get into we can take it down to the individual detail on the budget
That's a
sheets,
good
just like you say,
question,
but
though, and so we need to
but
highlight those.
that is a big one.
Yep.
That's a big number. All right, so that's the next multiple slides. That's page 1. That is a summary of the entire budget in 1 page. This is all revenues. Again, the same concept, just a little bit more detail. It breaks it out by tax collections on the top lines versus other fees like permitting fees, or it doesn't go to individual like it's a fee for Tyler's fees or Michaela's fees. That's in here, but it goes down to the revenue number. So like line 8, line 9, line 10, whatever, those are all individual ones. So this is a 1 pager of overall revenue that the county's expecting. Okay?
Yep.
And fund balances. The next 8 pages is the expense side of the state report. So this is again detail down to the level, individual expenses. And we have service areas. We have 8 service areas. So this particular page is mostly like the sheriff's office. My department comes out of function 8 and function 9. So it's broken out into each one of these pages. I have not entered this onto the state system. This is from Solutions. I won't enter it onto the state until you guys have settled, but this is the summary report that's due to you. Okay, so I wasn't planning on looking at each of the next
No.
8 pages.
Unless somebody.
You're welcome to, or
Yeah, I think that's fine, Jake.
when you look at each department, just know that it flows through to this.
Perfect.
Any $1 change one way or the other will flow to these.
All right.
Okay. Take a deep breath. Now we're gonna go to the old school. These are the old school, just the old cash flow worksheets like we talk about. We're pretty aligned with Lindsay's worksheets. We're pretty aligned too. We're pretty balanced. I don't know, don't know what to say other than this is what it is when we start out.
Mhm.
Okay, it's a big number. Big red number. This is the general fund. Now, remember straight off the top, 1.5 million out of the general fund is budgeted for Junction 92.
Right.
Okay, still leaves a
You gonna
pretty
own
big
that one,
number.
Tyler?
Still
All right.
leaves a pretty big number, but when you can look at each individual department and you can kind of start peeling that out.
Mhm.
Okay? And
If we accepted the budget as is, as you,
Yep.
you didn't say that. You didn't say, oh yeah, here's this. He didn't.
I didn't, I
Um,
messed
She
up.
caught you on that one.
Well, I'm not done yet.
The
I'm not
funding
done
and
yet.
balance would be if we spent everything, as Jake said, it's a budget,
It's a budget.
would be 3,000,000.
Yep.
305,
Yep.
504
Now, again,
in our cash.
and that also makes the assumption that 24 current year, we use 100%.
Correct.
Right.
And I think it's been determined, we generally run 92%, 93%, something like that. Is that about right for departments?
Yes.
I don't know. I'm not sure. Oh,
How much do we
All right,
generally
and so-
use in a budget cycle? Is it 90 to 92%?
yeah, that we use. Yeah. All right, so I used to always add if you add 5 cents to the levy or take 5 cents away from the levy, this is how much it is. So I did update that. So just for point of perspective, the $3.43 seems to be fairly cemented.
Yep.
But I would probably have a coronary if you got rid of the supplemental fund. So- Or somebody would.
Okay, I think that was a hint.
Tyler
Don't
would.
lower the
Yeah.
levy.
Tell Tyler that it all goes back. So
All right.
unfortunately, it is what it is. But 5 cents this year, 5 cents of a levy equals $98,000.
Okay.
Just for perspective. And we never want to lose sight of that comes down to tax statements that we all pay.
I think,
No.
when we look at that, and even though Tyler owned a good chunk of that red, the fact that we can pay for Junction 92 in cash spread over multiple years is a luxury a lot of counties do not have. So we knew that would be that way. That's not a
Yep.
shocker to anybody. We planned for it to occur as a cash deal. So,
We also have 500,000 budgeted in this year.
Yep.
For Tyler's shop. So maybe that helps make that red number in FY 24 look a little bit
Yep.
better too. But
Yep.
there's also the budget holds 500,000 for this year, I believe. Okay, Fund 2. Next one. You were right, unfortunately. Right there. Nope, that one. So this is what Fund 2 looks like at the current levy. Oh, that's a typo. I have a typo in the line 1. This is the one fund that you guys have some flexibility in. Yeah, sorry, the version 1 there on the bottom left should say 20.
yeah, I'm seeing, yeah.
Yeah.
That's all right.
What happens on cut and paste?
So when you see those numbers, just so everybody, who is looking at this, we have planned as a board to take this fund down. We're trying to get to a place where we match its liabilities to what its tax need is. Because previously, the fund was basically created to segment health insurance, FICA, some
It's a
other.
limited use. It has specific uses only.
Right, and it tends to be our employee benefits and some other miscellaneous things. But we reserve too much in it. And we need to have this more right size with what the actual cash flow need of the fund is to cover those costs. So it's had too much. We've been able to reduce the levy rate in the aggregate using this fund. So those numbers are planned.
Yeah, so you guys you'll see where expenses are going for the individual uses. The health insurance is what they talked about this morning. I think everybody budgeted 10% last year, and I think the budget just brought forth another 10%, so that may be a little higher than actual usage. By some departments, if it's family or single, those types of things. I know our liability, ICAP is putting out stuff, and I think they've, they're projecting a very healthy increase for ICAP, for property and liability insurance again, a healthy increase.
Yep.
So that is included in this. So Fund 2 is generally the insurances for the county and then the benefits. And then it also does, the EMA contribution. I didn't show that on the earlier thing, but that's required to be on our tax statement. But the EMA contribution is Fund 2. Substance abuse stuff, which we don't have a whole lot of anymore, is Fund 2. But it is a limited use. The piece of equipment that Tyler talked about this morning, that can't be paid for out of this fund. All right. So you guys will have to come up with a decision if you want to take out some expense or increase levy or leave it as is. Those
Right.
are your decisions on that case. Okay. Next one. I have a half hour.
Hey, Jake, go back to that just for a minute. I just want to see the final. I'm looking behind Renee here.
2.2.
Okay.
Got it. Thank you. Thank
Okay.
you.
What's this? What Fund 2?
Yeah, I got it. I saw
Okay.
the number I wanted to
Okay,
see.
sorry.
Yeah.
I got distracted. This is the Rural Services Fund. So this is a levy, that 395 that we talked about earlier. This is only paid by the folks that live in the township. So if you live inside of the city limits, you pay your own city taxes. You do not pay this 395. This is for only valuation in the townships. The vast majority of this revenue is in the transfer to the secondary road department to help maintain the secondary road department. It also does fund some of the uniform patrol services in the sheriff's budget as well. Those are a couple of the big main ones, and also zoning now. It funds the zoning department as well.
Yep.
So those are some of the main things. It, again, very limited use of what it can be used for. And again, fund balances were fairly consistent over years. I don't expect it to end exactly like it is, but you'll have to decide your comfort level there. It really can't raise the levy. You could lower this one because there's no rural, we used to have rural supplemental, but we don't anymore. And decide your comfort levels there. Last, I'm only dealing with taxing levy, so the last one is going to be easy because we've already talked about it. This is the debt service fund, Fund 40. It has a red number, which it generally doesn't. The deal with this is we had the grant money that goes in as a revenue from the state, the $1 million. And then also, so we don't have to generate tax dollars for that. So that's why it's only 448,000 of actual tax revenue because we've already got the money in the bank. Capitalized interest off the Pleasantville project would be deposited this year. That's being used as well. So, and ending fund balances because there is still more of that BA grant, and then we do carry a small balance for certain things. So that 572, 480 in red does not scare me, or is not an issue. I don't believe.
Right.
And I don't really think you guys have a lot of leeway in this levy, other than if you didn't want to use the VA grant, then it would increase the levy.
Right. Right.
Okay.
Very good.
And you can see it went from 32 cents to 17.
Now, Jake, we're getting some LMI dollars off of Prairie
So
Ridge now. Where are those?
This is the first year that we have that eligible, and we have not actually received any from the city yet. And part of that is because we haven't made those transactions yet.
Okay.
But that will be in this year. Corey was gone. Brian is here. He's new. We've both been busy. So there will be some LMI and TIF increment coming our way in this fiscal year yet from Pella. And then like that 79,000 we talked about earlier on the debt service, that's from the non-LMI portion of the Prairie Ridge
Okay.
for FY25.
All right.
So this will be the first year for that. There is nothing coming from Knoxville yet with VA. Then there is a separate fund set up. You guys will see on your month ends. There's an LMI fund that nobody else can use it except for those LMI purposes, and it will just stay there until you use it.
Okay.
I think it's like Fund 85 or something
Yeah.
like that.
Okay.
Low to moderate income housing is what that is.
Right.
And it's
Right.
only the Prairie Ridge TIF that's generating.
Correct.
Adkins is not, because it wasn't residential. So that's your 4 levying funds. That's the extent of what you have. The last, is there another?
Yeah.
threw this in because we always do. Been kind of a topic lately, and I imagine it will be in the future as well. But this is kind of, and with Tyler's assistance, this is kind of what you guys have been planning for on the capital projects portion of the local option sales tax. I will say that this is using the assumption we've effectively used current revenue numbers with same distributions to the other two jurisdictions. So if anything would change in that projected lost revenue of 800,000 one way or the other, up or down, that would affect this ending balance.
Right.
Right? So we just effectively held status quo on that. I know of no other projects that you guys are planning on, and as you can see in FY '24, the $300,000 LEC transfer to make that principal and interest payment is no longer needed in FY '25. So that will just stay into that Fund 29 or the local option sales tax fund to be used for the Junction 92 project.
Okay. Very good.
And that's my usuals.
And do we generally
is-
though, do we determine I mean, obviously 50% goes to property tax relief. Is that, then we determine those values, whether it's 30 to,
Yeah, that's a good
General
question. I
fund
did
or-
not include this sheet. The budget with the revenues just assumed your 30 and 20 again. And you actually may want to look at changing that, those percentages or, so it would be 30 and 20% of the 800,000. Right? So you put 30% to the general fund to help with that levy and those expenses, and 20%, I think it is, to the general supplemental. You guys could change that, and you may want to. You may want to move more to the general fund.
Yeah.
Because it doesn't have any flexibility, the general supplemental does.
Right.
So, but the assumption is you're correct, and it's 30%, 20%.
Yep.
Of the non-capital projects. That makes sense?
have we heard anything more from Pella?
They will be on the
have.
agenda next February 13th to present.
So I made these assumptions based off the.
I
old
don't
steps.
want to steal anybody's thunder, but they're going to want to leave it the same.
Oh, wow. That's what this is. This is that effectively, so. And Tyler came up with, the 3.1 million is into his plans for the uses of the other funds, so. He'll probably talk about that in a little bit. That's what I got.
Jake, thank you.
Questions? That was over, just high level. Just please understand, everybody, appreciate that they put in their individual requests, because that's how all this flows through.
Excellent. Any questions for Jake on that? They always does such an excellent
He
job
does, yep.
explaining the technical aspects of this, which I don't know how he remembers it all.
Jake,
It's been,
we appreciate you. I appreciate you.
thanks.
Yes, thank you
Appreciate
for
that.
being our clerk and on top of all the other duties that you have. So,
Appreciate that.
All right.
That's what I got. That's my kickoff. Now it's all yours.
Excellent. We
Thank
don't
you,
need to,
Jake. You make it easier for us that don't understand the totality of it. But
I don't know.
you make
there's
it
so many
easier.
moving parts,
There's a
but
lot of moving parts, and it takes every department to make it work, and they do a great job.
all right, Tyler, you're up.
Where's the PowerPoint?
You're looking at it.
Wow.
Whoa.
I did this while I was sitting right there, so.
Feel like you didn't have anything else to do.
Here's how
Right.
my last couple of weeks I went. I found a burrito that I don't know how old it is in my coat pocket. And
You
I
ate a
found-
burrito that was in your, what'd you say?
Yeah, I found a breakfast burrito in my coat pocket, and I have no idea when I bought it. And there was some other uneaten lunch that came sliding out from under my seat one day, and that's how my weeks went.
Oh.
While we're on the topic of levies, and I made a few notes here that pertain to us, obviously. So Fund 11, you saw that was under the fund balance. The net result of the fund balance was less than $1 million. We'd been kind of right at that $1 million mark. I will say part of that, yes, our secondary road transfer comes out of Fund 11, but a direct payment is for our IRVM program. And we do have a 70 to $100,000. It's $100,000 expense, hoping for a $30,000 grant. That's a one-time expense budgeted for Fund 11 for our IRBM program to replace our hydro seeder.
Okay. yeah, I
So-
remember you-
Just wanted to point that out while that was fresh in your mind after seeing Jake's spreadsheet there. Then it will return back to the normal budget that we have in our IRBM department. Okay, so yeah, no spread, no PowerPoint, no slides, no charts or graphs this year, so bear with me. So our two main revenue sources are road use tax and property tax. So road use tax is 60% of our budget. The Iowa DOT's estimated increase for road use tax is 3.2% for this year. The 8-year average is 1.66% of actual. And as you know, CIP or CPI is 3.04, 8-year average, and 5-year construction price index that the Iowa DOT does is actually 9.4%. So that's kind of the challenge we face there. And at the same time, we've seen the last 3 years, 11.5% increase average over the last 3 years in our aggregate prices. So our rock out of our, $8 to $9 million road budget, that's nearly, it's like $2.1 million of our budget is in aggregate alone. Plus any concrete, asphalt bridges that we do also have aggregate in them. So our second main revenue source, which is about a third of our budgeted revenue, is the rural property tax valuation that is transferred from Fund 11 to the secondary road fund, from that levy that you set. And then, graciously, this board and previous boards have transferred the maximum amount statutorily from Fund 11 to the secondary road fund. And so what we're budgeting there is a 2.1% increase in our secondary road fund transfer or our property tax revenue. And I've mentioned this at the Farm Bureau meeting I attended a few weeks ago. For your rural, how'd you describe it, Jake? Your township taxpayers.
There's 12 townships.
Yeah, your township, rural taxpayers, that's a tax only on them. And that's about 11 to 13% on average of their property tax bill ends up with secondary roads. So highlights of our budget expenses. So moving forward, I have taken 2 full-time. Yep.
I got a question. You said your road service tax is 60% of your budget, rural fund is 30%. Where's the other 10%?
Yeah, it's almost 2/3 and 1/3. And
Okay.
then there's like a 3% of miscellaneous this year, from the fees Jake was talking about for permits and whatnot. Sometimes we have grant reimbursements that I'm budgeting, fixed asset sales, and the occasional project reimbursement, like I talked about in the meeting this morning. If I budgeted $500,000 for a bridge and we get reimbursed from the feds, I'll show that as revenue as well.
Okay.
But this year it's basically fees, and I think, yeah, I did say 60%, but it's really 1/3 and 2/3,
That's
basically.
okay. I just,
So on the expense side, I have made the decision to not fill 2 full-time positions through attrition. So I took those 2 full-time positions out of our budget. Hopefully we can sustain that. There's times when that's a little bit challenging, but with the move to Junction 92, I think there's possibility for maybe some restructuring amongst our department that would ease that a little bit. And at the moment, we are still operating with 3 fewer full-time employees than this time last year.
so you'd be down 5.
Down 5?
Oh,
We have 3 fewer and plus 2 more.
No, I'm sorry.
Okay.
Currently, I'm down 3. Those 2 full-time positions I'm taking out of the budget.
Oh, so
I
you
don't
have
have
3
those
3
employees.
total,
3
you're not,
total.
you're only.
Yeah, I have 1 on military leave, 2 that have already retired and I did not fill their position. but they were in our budget in the current
Got it.
fiscal year. I removed those full-time positions completely from our budget. for
Got it.
next year.
Thank you, thank you,
Sorry.
thank you. I was thinking 5.
Nope. So overall, that is a net result in my budget change from last year to this year in wages, 1.6% change in wage and 0.6% change in benefits from what I budgeted last year to this year. And part of that is because Renee and Lisa have helped me, zero in so we can more accurately budget for Fund 2, what our actual dollars are on benefits, so we know exactly which employees are on which plans. And I think we had a big shift. We had a big shift to the high deductible plan, which brought my budget down on the county side.
Excellent, well done.
So that's what resulted in an overall wage increase of only 0.6% for our department. So for actual employee wages, I budgeted 6%. Most employees will be at 5%. That additional 1% is for the second phase of that equalization that I talked about last year for various positions. I will say, when we reevaluated this year, which Tammy did, she called each of the 10 counties, 5 above, 5 below. And actually, Marion County is in the 21st percentile by population now and not 22nd. I don't know if, yeah. So we were evaluating off of that, so that was a little different. I think we added a county on the bottom side is what happened there. So she called each one of them to verify each individual wage comparison that we were looking at, and most of those trued up to what we did last year. So we're grateful for that. Still have a few positions. That's what that additional 1% is for those few positions for that second phase of
Is there any way that
equalization.
we can bring up is any of this you're following what you put in data on your sheets? You're not following any of that? Are you just doing highlights?
Right. I'm just doing high level.
But I
stuff.
would, Lindsay, could you just pull up his road department sheet? I think that's a good idea.
And then you will see an increase in admin and engineering. That's all in the engineering side. Typically, those have been decreasing year after year. On the engineering side this year, we have the 168th bridge that if you recall from this morning, that is fairly unusual to have that local federal aid bridge where we're incurring the expenses. It does happen from time to time. We have some Junction 92 construction inspection costs there for special inspections. And then bridge inspections and ratings. I think I've mentioned this to you in the past, but there's lots of legislative changes going on there. Our contract for our routine bridge inspections remains the same. What we're incurring more costs on, or what I'm budgeting for, is for re-rating of bridges for new state and federal laws and changes to the MBIS system, the bridge inspection system. So for construction, you guys this board has approved various agreements between Marion County and the DOT for some side road paving projects, nothing large scale, but we do have those, excuse me, those joint projects and agreements in place. So I had to budget our share of those costs. We have a joint project with Jasper County Line to replace a bridge. They will be building the bridge. We will just be funding half of that construction cost. And then we do have one other bridge planned. That project coordination I was talking about earlier with the DOT may impact whether that actually happens or not in this fiscal year. Because it would be on a potential detour route. We wouldn't want to remove a bridge and make a 4.5 mile detour, 7.5 mile detour. So we will wait and see, but we do have that budgeted. So there may be a program amendment related to that so we can do something else. Bridges, culverts, road maintenance. Overall, there was a reduction in our maintenance budget for those types of things by $325,000. And, I talked about rock earlier, that 11.5% average increase. I reduced the tonnage of maintenance rock. So this is the rock that we surface roads with. Some of that reduction was what we talked about earlier, roads that have been stabilized. So the net there was an 8% increase in maintenance rock instead of 11.5. And then we reduced repair rock, shoulder rock, and road regrade rock, which resulted in an overall aggregate increase of 3% for rock, all types of rock. Snow, salt, sand, signs, pavement markings all generally stayed the same. Some minor fluctuations there, nothing major. New equipment, the budget is up 30% from last year. But I have a long-term equipment replacement plan, and I reduced that by 300,000 from what we had planned. So that's basically one dump truck I took out of the budget from what we thought we were gonna do a year ago. And I don't know if you remember from last year, but we bought, I think I had budgeted 1 or 2 motor graders and I bought 3 used. So that motor grader is already out, removed from FY 25. So technically, we took a motor grader and a truck out of FY 25 from what we had budgeted a couple years ago. And then fuel's down about $80,000. I've already contracted the first 6 months of FY 25. So we're contracted through, actually, I think through November, not through December,
Okay.
technically, on gas and diesel. And
Tyler,
parts are up 10%.
when you say budget up 30%, are you talking to certain items? You're not talking just in general?
Talking
Because-
my new equipment budget is
New
up
equipment,
30% from prior year budget.
Okay, thank you.
Just in dollar.
Because I was like,
Dollars,
I'm
yeah.
looking at your overall budget and it's not that.
No,
much
new,
of an
new
increase.
equipment budget itself is up 30% over last year's.
Yeah, you'd be doing something else if his budget was up 30%, wouldn't it?
So parts, I hadn't increased parts in 5 or 6 years, and actually, as we had been replacing equipment, we have less repair in-house. I'm trying to keep more and more things under warranty. We're buying 10-year warranties on motor graders right now. We've been trying to keep that stagnant, but stuff just has inflated so much that we had to do something on parts. So I looked at our 3-year average and had to increase all parts line items by 10%. So I'm already at my summary, overall summary here.
Lindsay, can you go to just the sum totals for Tyler? Yeah, just so we have that. While he's summarizing, we'll go to the summary.
So overall, our budget is showing $2 million more expense than what we have revenue coming in. But if you look at my fund balance is like $3.2 million. And we've been planning, we've had that growth in our fund balance intentionally, partly for junction, partly for other reasons. And of that 2 million, 1 million of that was budgeted and planned for junction 92. So the other 1 million could possibly come into play next year when we talk about, reducing more line items. Our budget runs kind of like the countywide total. We operated about 93% utilization of our budgeted expense. So, would that offset some of that? Sure. We'd have to reevaluate next year. There will be less project money. So when I talked earlier about the construction budget and also the engineering for various projects, we won't have some of that next year. So that can offset some of that additional $1 million, to get us to a balanced budget next year. And there is, I think 2 years ago, maybe, I talked about the tiers of cuts that the road
Right.
department could incur. We're into some of those second tier cuts now, and there's still a little room there. So I think next year we'll be evaluating, how true is that $1 million that we're overspending today to get to a balanced budget. So if we spend 100% of what we're budgeting right now, it's going to take us to that 1.1 million range, which has kind of always been our, the bottom end of our comfort level, $1 million to $1.5 million in Fund 20's fund balance. Typically, we don't spend 100%. So I think next year we'll really be just towing that line of having a balanced budget, but a lot of these big projects will come off the table, and hopefully we don't see some of the inflation and that we've seen recently, and things mellow out a little bit, but that's all I have today, actually.
So Lindsay, can you pull the headings down so people can keep track of what AK, AL, and AQ are saying? And oh, okay. So then tell everybody what AK, AL, and AO is. Right. So remember, we did a 90% appropriation on operating expenses last year. We excluded salaries and benefits. So that's the differential between AL and said AK. And then AO is proposed. That's in the aggregate. That's everything. So Steve, Keisha, there's a good chance to ask Tyler any questions. I just like on the 6%, Tyler, maybe a little more color. So you're thinking 6% for staff,
Yes.
and you're thinking in a bucket
6%
context.
bucket, within that, most employees I had at 5% wage increase with, there were a few positions, job titles or classifications that weren't quite where they needed to be for that equalization that we had looked at. And I told
Okay.
you last year, I thought that might be a 2-year approach. A lot of those became truer than I expected,
Okay,
which is good. That's why we didn't do it all in 1 year, to reevaluate. So that 1% in our budget is to kind of finalize that
okay.
wage equalization for those various positions compared to the 5 counties above and the 5 counties below, same positions above and below the 21st percentile.
Okay, very good.
Tyler, and remind me, what did you give last year then? Is it the same thing? Was it right along?
So I
that?
budgeted, it was 5, and I think it was like 6.5% or something like that. Bucket. And then some positions got 5, some got 6.5 or 7 because of that equalization.
Right, yeah, I think that's ultimately, once we listen to everybody, I mean, I know we'll have further discussion of what we're looking at, but.
But overall, our wage budget is 1.6% increase because we're eliminating 2 positions.
Just in the aggregate though, Tyler, you're thinking about a 4 to 5% total increase in the budget.
You said 1.6.
Well, I'm talking
Yeah,
about
but-
all in.
Yeah.
All in.
I don't know.
I'm just doing my quick. Yeah,
Something like
I think
that.
it works out to be about that.
Once you remove the 2 positions that you absorbed.
Well, I'm just using those numbers, Keisha. Just want to make sure I'm getting.
4.5.
It's about 4.5.
Yeah, this one, 4.27.
Just want to make sure I.
That
tracking it.
is something that maybe for next year, that is something that Solutions does that is helpful. And that was, didn't know if we can,
Yeah.
it shows the.
Yeah,
the
I think
difference.
that's a great comment. So that's something we can add. Yeah,
Yeah.
what that percentage increase would be.
Yeah. Because I know some of them didn't do a percentage when they increased. And so that you have that
Yeah.
column over there. And
I didn't. I just put in the dollars out of my own spreadsheet.
Reversing it for everything else. So they would put in a dollar amount and it would calculate the percentage increase, if that makes sense.
Whatever, yep. And maybe a column in AP that just does the math. for every
Automatically
line item
does it,
by
yeah.
percentage
Yeah.
too.
That's possible.
Work in progress.
Mhm.
Yep.
Yeah, very good. Board, any questions for Tyler?
And those numbers you're looking at there, that Fund 20 total is our secondary road
Yes.
budget. The grand total you see includes Fund 11, that direct IRVM expense that's under our Department 20,
Right,
but not funded out of the Fund 20. And then also the Fund 2 expenses are
Correct.
in that 11.5 million
Correct.
total.
right. Everybody got that?
Yep.
Steve?
Yep.
Okay.
Thank
Tyler,
you, Tyler.
thank
you,
you
Tyler.
very much.
Thank
I'm
you.
sure we will come back.
That's a record.
Yeah, I don't even know what to do.
Yes, it is.
I don't even know what to do. I mean, when has it occurred in this one? Jake has talked longer than you have.
It was painful.
Like 23 minutes. Wow, that's a record, everybody.
No, thank you, Tyler. All right, next we have Impact,
I
and
forgot.
we listened to them present this morning. I don't know, is anybody online? Kim has comments? Okay, let's go get Kim. I will see. Let's get through this one first. Is anybody from Impact
I
online?
doubt it.
I don't think they're on. Okay. So their actual, I mean, the request was for 12,000, right, Keisha? Same as last year?
No,
Or
so-
what?
No,
So we have done in the past, we did in kind when they were at Sixth Street. They haven't been at Sixth Street since about COVID.
Okay.
I didn't want to necessarily, you know, have a conflict with them here, but I disagree with, and I believe the numbers show differently in regards to, do people really want a phone, be able to pick up the phone and contact them? People still want to be able to go someplace and visually speak with them, because we knew that because the numbers decreased in servicing. When they only did phone calls and, for applications. Some of the LIHEAP that they receive, it is somewhat considered, once you sign up for it, and then as long as you qualify, it's just sending it out again and
Mhm.
saying, yes, fill out this information. So,
So
I
it's kind
struggle-
of, so it's kind of an automatic.
yes, I struggle
Disqualification,
sometimes
okay.
with the amount of numbers they're saying. I do think, and when I say struggle with the numbers, with how many they're actually connecting. I struggle with it, us being in Polk County, because Polk County gets majority of all the funds. I will say Terry has done a much better job about connecting and wanting to try to help Marion County. It seems like even with the money that they had, Steve, you have their numbers there. I forgot to bring that sheet. When you look at how many they helped, even with weatherization, that's like, 8 homes.
Mhm.
That's a tremendous, 145,000.
That's a
It-
lot,
it-
that's a lot of, that's a
that's a
lot of
lot.
money for eight houses. yeah.
So you got 337, which is LIHEAP. And
Well, let me ask this question, Keisha. I mean, like I said, you're closest to it, and we've talked about this for several years, and I think Kim might have some comments on this as well. Would we be better served by shifting those dollars to our general assistance fund and managing some of that more in-house within Marion County? And I don't know, the service overlap is where I'm struggling a little bit here, but
well, like LIHEAP, that has to go through them. I mean, it doesn't seem
so
like.
we don't have that.
We don't have
ability,
that.
So
Yeah. Correct. Yep.
that's a
So-
federal program. Yeah,
Yes, that they, yeah.
so they would do that no matter what.
And I was saying to Mark that oftentimes when you qualify for LIHEAP, it's filling out that information and you can qualify again. I mean, the numbers that they're putting out there saying that they're reaching, I struggle with, that number, because I'm not quite for sure how they're getting all those numbers.
Yeah.
I-
Kim, do you have any comments
That
on
would
that?
be an accurate concern, maybe.
Yeah, what were you thinking?
Well, after this morning session, I ran out and talked with Dell, who does our general assistance, and some other staff, and had them do some checking on some things. And they called the library and they said the library told them that they're not coming here anymore. So there's no office hours here.
They said that today. That's what they said today.
Yeah.
They did say that they're
And-
not coming. No more?
Yeah.
I thought that they
And-
were coming. Actually,
It's on phone.
Yeah,
in
they
home.
said that that the clients prefer to do that over the phone, but I had somebody who was a client there that they called them to get assistance with furnace. And they said, well, you can have a phone appointment in February, or you can drive up to Ankeny office and be seen tomorrow. So then that person, had to take time off of work and go drive up there, and it was a 15-minute appointment. And it was, so it's not flowing. It's not flowing very well, I guess is what I should say.
Okay.
But I think that their request was specific to homeless and rent assistance and that. And for general assistance, we require that they go and, they go around to everybody who helps with that. And
To them first, yeah. to
Yeah,
Go to those
and
other locations
they-
first.
the comments that I got were that they haven't, we haven't had anybody that we've referred to them that's gotten assistance for that. So, and.
I have a
and
feeling
if you
it's like
think
most
about it,
things, they get the money, they've got this, these people call and then they take it all, and then it's gone, and you're servicing the first few months of the year when which you get to receive the funds, and then it's gone, and so.
Yeah, well, and we wonder if it wouldn't be more efficient and effective to just give it to general assistance for that, because then we're not reaching out to somebody for a service that we already provide to get a denial from them so that we can provide it. I mean, it's just this crazy little circle.
Right.
Well, this 12,000 that they're requesting, how do we know that actually goes to a Marion County resident?
They weren't clear on that, and I don't know.
This is the way I heard it. I don't mean to step into this game.
No, that's
but
fine.
The way I heard it was it's not for services. It's for an at-risk program.
That's
So
what
it's
I.
not
that's what I
going
heard.
to an individual person is my that's the way I took it.
And
It was
there's-
for a,
And Jake, there's
for
an
a quote.
overhead, there's an overhead component to that as well.
I
right?
would assume, I don't
Yeah.
know what the admin percentage is. It looked like they had
What's the
some admin
$12,000
percentage.
getting it, Jake?
I don't know. I mean, it was it seemed to me like it was to create a at-risk program, but it
Also
wasn't for
create
direct
a new
services to a
program?
client.
Yeah. we
And
already
then
have
start some
program
collaboration
that's-
is what I heard.
Yeah.
And
So-
there is a group that meets around homelessness. And I had them check to see like if they've been coming and that, and that they've
Yeah.
not.
Yeah, I just can't, unless we are certain that these dollars are truly going to Marion County residents. And it's not going for overhead or creating some new structure that we have no idea how it will be performed. At a minimum, to me, you're better off putting it in our general assistance fund and managing it here in Marion County. At least then we have the care coordination aspects that Kim has instituted within senior nutrition and those things. So we know that they're getting the variety of services they may need access to.
I do
We
think
would
though,
need
if we went that direction, we'd have to change how we do general assistance, because don't we currently make them all go around and ask these
We-
other places first?
Yeah.
I honestly would prefer Impact to have to show to us that they're actually changing and there's things that they're really wanting to do in Marion County. They have to become more involved. And one of those, the last time I saw the numbers was being here. And I'm gonna agree to disagree that I don't think people just want to do phone interviews.
Well,
So-
yeah, so what are you suggesting,
I'm
Keisha?
saying that we,
You
do
want
not-
to, you want to fund them or no, or
not-
just say,
no.
don't fund them and prove your point?
yes, yes.
That's kind of where I'm at. If you
Yeah.
can prove your point, then I may think about funding.
But that's not gonna happen this year in this budget.
Okay,
That's my,
okay. I'm okay either way. I mean, to me, we have a general assistance fund. And I would say, Kim, what we need to do though is someone's got to write herd over this from a service standpoint. Because I think that's where we get lost. I mean, it's one thing to be on the board and try to listen to the board presentations, but they're probably much like this. Right?
they're high level, yes.
Right.
yeah.
So who's going to ensure that those things are getting done? So when we come back to this a year from now, people don't go, well, I still don't know if they're doing things here. How do we do that? How do we resolve that? GA could be two different funding sources. The 12,000 could be used for eviction cases. What does that mean?
they've got an eviction notice.
So that would be the criteria.
I think we'll need to really think through the changes that we would need for policy and procedure.
So let's,
Let's not do any knee jerk today.
yeah, so let's do this. I think you're right. Let's make them prove their point, but no money.
Yep.
And then Kim, I think another path is public health work on something, a more formal structure to maybe take this over, or whatever services they offer that they can take over in the event they don't live up to what they promised. That sound like a
Well, yeah,
reasonable?
if we're going to commit Marion County dollars to Marion County, I want to see them used in Marion County.
Mhm. Yeah, absolutely.
And they did receive $5,000 from United Way, and they have to prove through United Way that they were spent in Marion County. So that's going to be one test.
Okay,
they-
well, it sounds like we have some consensus on this. So would anybody like to make a motion on impact? And I think the motion would be no funding for this fiscal year, continued relationship, and to see if they can actually provide the services that they're supposed to within Marion County. Anyone? Anyone?
I say so moved, so I don't have to repeat that.
I'll second that.
Ramey,
Aye.
Johnner,
I,
McCombs.
Aye.
We decided one thing already. All right, I like that. Scratch it off. Miscellaneous countywide budget.
I just put that on there as a catch-all. So there was nothing direct.
Okay.
I didn't have anything direction for this. It's
Okay.
Just,
Any other items that the board would like to discuss today? We've got a big day tomorrow. We kind of get into the nitty gritty. Take time to think about all the things that Jake talked about. I always appreciate his overview, and of course Tyler's Cliff Notes version of his presentation. You've got access. Do the board members have access, Lindsay, to the spreadsheet? Okay. So if you have not opened that up to look at it, make sure to ask Lindsay how to do that. We sure appreciate everybody participating in our test run here on how to maybe systematize this a little better.
Lindsay, is there a fund balance tab? Can you show where that is?
Oh, can we look at, we'll do this. Yeah, could we do that first since it's there? I want to interrupt you, Jake.
It's just,
So just so you can see, tomorrow we've got zoning first, and then we'll see if Missy gets here. We hope she can. Then public health, and we got a little break. Then we pick up with maintenance. So there's the rest of the schedule for the week. Big week, and then we'll wrap up things on Friday. So yeah, let's go to the fund balance tab. Okay.
is there a quicker way to go from like Department 2 to Department 99, or is it just kind of?
Okay, so if you use this little lines box right here, it gives you a list of all the different tabs.
oh, okay.
And
Where?
so
Sorry, I was.
right here, so the left and right arrows, and then there's the 3 lines. If you click on that, then you get the whole list of all the tabs.
Oh.
So there is a fund balance tab. And
Oh, I didn't see the totals. I just saw the departments. You have
Yep.
it subtotaled
so,
down there.
so there's
I got
revenue and expenses for each department that is inputted into that particular fund. So, so like, for example, for Fund 11, if a department doesn't have revenue or expenses in Fund 11, they're not listed. I just hid them for the sake of space.
Right.
But what's good about that spreadsheet though, that I really like, is that you'll see which departments pull from each fund.
Right.
And which departments contribute. So like when Tyler says he gets money out of the Rural Services Fund, he actually shows up in that fund.
Right.
And that'll give you a good idea of who's taking what from each fund. I really think that's an excellent or some
Yeah.
additional information.
Thank you for showing
Yeah.
that, because I couldn't figure out how to get to that, so.
Yeah, no problem. So
But-
it's the first one. It's called fund balances. And then, like I said, I hid the individual lines just so that we could see each of the beginning and ending balances. And then this flows through to all the other tabs. So tomorrow, like when Kim gives her budget, if we update that in here, it'll flow through into Fund 1, into Fund 2, and update the ending fund balances.
Right.
Yeah, update the balance.
Yep.
It'll update the balances if we make sales tax changes.
Right.
That'll flow through.
Yep. Yeah, Department
So
99 is in here
Anything
too.
that
So
we make
anything,
those adjustments on will flow through the entire spreadsheet. So it'll be a great.
We're
right.
making it easier for us, not so technical.
I'm trying. We'll see how it goes.
All right, very good. Well, good opening. Appreciate it. Thank you. Is there a motion to adjourn?
Motion, we adjourn.
Second,
McCombs,
aye.
Ramey,
Aye,
Johnner.
Aye.
very good. We are adjourned. Thank you.
Thank you.